Good evening, and thank you for taking the time to join me today. My name is Sara Waqar, and I'm a prop trader and a financial mentor since over a decade. I have a primary focus on commodities, currencies, and stock indices. I am also certified from FINRA in USA, and I'm an investment manager aligned with the CMA UAE regulatory standards. I have been running professional trading courses for retail traders since 2015, and I focus on building disciplined approaches to the markets, focusing not only on strategy but also risk management and trading psychology. So, welcome to Amana. Please read this disclaimer on the screen before we proceed. Amana is a brokerage with both local and international regulations, which are in front of you. So, we have the DFSA and the ESCA or CMA regulation from UAE, and then we have all these other regulations such as SISEC from Europe, CMA from Lebanon, FSC from Mauritius, and so on. We have a specialized focus on the MENA region, and we offer over 5,500 assets across global equities, MENA equities, over 100 plus digital assets, forex, commodities, stock indices, both leveraged and unleveraged. If you have any questions during this webinar, there is a Q&A section that you can see below, and you can drop your questions over there, and I will try my best to answer them. So my colleague is here with me, and either he or I will answer your questions. If you want to get in touch with us, you can email us at support@amana.app, or you can call us, you can do live chat on the website, or you can get in touch with your relationship manager. The topic of this presentation is risk management. But before I do that, I want to very quickly go through some concepts which are integral to risk management. And these are leverage and margin. So I'm sure that, a lot of you who are familiar with trading know that, there is leverage or borrowed money or extra money that you can get from the broker to open a trade, which means that you don't have to put up the same value of capital as the position size. You can actually put up much less capital and actually end up opening up a very big position, and any profits or losses from that position will be yours. So leverage is actually a multiplier. It's like I said, the money that you can actually borrow from the broker to open a much bigger position than your capital. And the margin is a concept which is completely related to the leverage. Margin is the money that you have to put up to open a position, which may not be the same value as your position because you are using leverage. So, for example, if the value of the trade that you have taken is $10,000, you may only have to put up only $100 to open that position. And why is that? That is because you got a leverage of 100 times from the broker. So in order to open a position of $10,000, you only had to put up 1%, which was $100, which is called your margin. The margin and the leverage are inversely related. The higher the leverage, the lower the margin. As an example, on a $1,000 account, if you have a leverage of 1 to 100, you can actually control 100,000 of any, you have 100,000 of buying power. So in this case, what you're doing is you're using the maximum leverage. So with $1,000 only, multiplying 1,000 gives you 100,000, right? So just with $1,000, you're able to open up positions up to 100,000. And this is the relationship between margin and leverage. So a 1 to 100 leverage means a margin of 1%. 1 to 200 will mean a margin of. So as we proceed further, you will understand more about this. But just remember that, leverage is something which is inbuilt into the trading platform. And okay, so leverage is something which is inbuilt into the trading platform. It is already there, and it is something that will be known to you when you open the account. So if we go to the Amana app here, and you select any instrument. Let's say you select gold, which is given by XAU here. So when you select this, this is the chart for gold. And what I do is I'm going to scroll down. Okay, I will scroll down after selecting the instrument on top, which is gold. And if I keep scrolling down, I will see here leverage, which is 20 to 1. Okay. So what this is basically means is that if I have to trade, if I have to open a position worth $20 of gold, I have to just contribute $1. Okay. So here the leverage factor is 1 to 20. And what is going to be the margin? The margin is going to be 5% because yes, it's going to be, so 1 is 5% of 20. So what this means essentially is that if you open any gold position, you will only be required to put up 5% of that amount as margin to open the position. So margin is not something which is deducted from your account by the broker. It is just an amount which is shown to you that, okay, this is the amount which is being put on the side to open this position. And even once you close the position, that same margin is released. Going back, so why was leverage actually introduced? It had a lot to do with reducing capital requirements for hedgers to allow participation in large markets and to improve market accessibility. So first of all, to make trading possible with huge capital means that originally, markets like currencies and commodities were traded using very big contract sizes, and you could do these trades just with the banks. So a bank would probably have the minimum unit size of, let's say, 100,000 worth of currency or commodity, which was difficult for smaller traders to take part in. So most participants could not afford to pay that value. So hence the leverage, using the leverage instead of paying the whole 100,000 upfront, you could just deposit a small amount with the broker, and using that small amount or margin, you could control the bigger position. So that actually allowed smaller participants or retail traders to trade and become part of the market. So it was basically introduced so that different market participants could participate without the need of putting up excessive capital or big or more capital. So this also ended in improving market liquidity because more participants mean better market liquidity. So you just don't have institutions, you have many other buyers and sellers as well. So let's move on. Yeah, so this is again going into detail was why leverage was initially introduced in the market. So I talked about improving liquidity because of the leverage, more people, smaller participants could join the market, which created tighter spreads, more efficient and continuous markets. Then it enabled businesses to lock in prices and protect against risks. So price hedgers, such as any type of business, such as gold businesses, oil companies, airlines, exporters, could actually who facing any kind of price risk, such as the price of oil going up, could take an opposite position using leverage on the platform and hedge their price risk or fix their prices. So then it has increased efficiency, because it allows you to open different positions using smaller money. So you can actually diversify. You can open more than one trade. You can enable it actually allows you to go into more markets with the same amount of money. But leverage also has a disadvantage, which that if you use too much leverage and you are just controlling a big position size with a small amount of capital, you can very easily lose your capital because the loss on the big position size can actually be equal to your capital. Just as an example, if you just have $1,000 in your account, you have a leverage of 1 to 100, which means you can actually open a position up to 100,000. And let's say you open a big position, you open a position of 500,000. Now, to make a loss of $1,000 on a position of 500,000 is very easy. It can be caused by a small market fluctuation. Now, that means that you can lose all your capital because you only have 1,000. So then it becomes very important that you actually understand how to use this leverage and how to apply it properly in your trading, because using too less can obviously deprive you of opportunity and profit making, but using too much is going to make it extremely risky. Then the question arises, how can I use this leverage? What is the optimal way of using this leverage so I can benefit as well, and I will also not put myself to risk, and I will be able to control my risk. And the way that we do that is through risk management. So I will move on to risk management now. So risk management is basically, it's about planning exactly how much capital you want to allocate to a position. And it is something which is very much undermined by a lot of traders, because all of the time, if you go and see in the financial markets, we are all just talking about, the predictions. We're talking about how the markets are performing, what is happening to gold or Bitcoin or the indices or this stock or that stock, right? And a lot of focus is on the strategies. How can I predict the market? Where is the price going? What indicators should I use? What methodology should I use? But there is very little focus on risk management. And there is actually, I think this is something that needs to be highlighted again and again, that risk management is far, far important than your trading strategy or your predictions about the market. Because if you do not do risk management properly, especially when you're using leverage, then it can actually lead to the loss of your capital, let alone your account growing or you making profits. And even if you might be right about the market can be so volatile, it can be so tricky, that you might end up doing so many different things that you didn't plan because you were not confident, you did not do your risk management, and you got confused. You afraid when there was a little move against you or whatever. But when we do risk management, primarily what we're doing is we are allocating a certain part of our money to the trade, and we are fixing that. So no matter what happens, even if the position goes against us, that we will only lose that limited amount. And that is the most important thing. It's actually the foundation of successful trading. That, you need to actually have your risk management in place once you finalize a trade. So if you look at famous quotes on risk management, we have Warren Buffett saying, rule number one, never lose money. And rule number two is never forget rule number one. So again, the concept is not first about looking at how to make money. The first step is how not to lose the money that you already have. The first rule of trading is to preserve capital. And it's not whether you're right or wrong, that does not matter, but how much you lose when you are wrong is what matters. So this is George Soros, who made billions out of a single trade. So the focus, like I'm saying, has to be first on risk management, and then it can be about, trading and, strategies and the market and all of that. And the thing that we have to understand is that if we lose money, it becomes increasingly hard to recover it. And a lot of people don't understand that. So, losses hurt you more than gains help you. And why is this? So this is because let's suppose you have again $1,000 in your account and you lose, so you lose 10%, right? But to go again from 900 to 1,000, you have to gain 11%, not 10%. Similarly, if you lose 20% of your account, you are down to 800, right? But to go up from 800 to 1,000, that means you have to increase your account by 25%, not 20%. So what happens is that these successive losses actually mean that it becomes more and more harder for you to recover. And yeah, so what that means is if you lose half your account, if your account is at $500 down from $1,000, you actually need a miracle, basically. You need to double it to go back to what you originally had. So the best thing is don't lose money, do a risk management. That's the best thing. And risk management doesn't mean you will not lose money. What it means is you will actually, would lose a very calculated amount, which can be very easy for you to recover later on. Now, there are three things which are involved in risk management. The first thing is the position size, and the position size is the quantity that with which you trade, and this is your in like most integral tool of doing your risk management. It is how much quantity you will trade. So you can trade any quantity, you can choose any quantity, right? And because the leverage is there, it allows you to place big trades. So you can be free, to, trade big or small, whatever. But position sizing is not done randomly. That position sizing is done in a very calculated manner. So I'm just giving an example that most people will say that, okay, maybe 10, they want to trade 10 ounces of gold, or they want to trade 100 ounces of gold. But this is a random thing. This is something random. So if I go to the platform and I want to trade gold and I want to buy here, and I'll be changing this from amount to units here. So unit means the number of ounces I want to trade, and the price of 1 ounce right now is $4,494, right? So I want to trade 10 ounces, which means that the total value of my position is $44,000 because 1 ounce is 4,494. Or I want to trade 20, which means that my position size, which you can see here, so the exposure is the total value of the position. So that's $89,000. I can do that. I have $52,000 in this account, right? I can trade I can trade 100 ounces, which means around, that's around $450,000. I can trade maybe 200 ounces, which is around $900,000. Okay. But all these numbers are just random and they should not be. When you do risk management, you calculate a very precise quantity that with which you need to go in the market. And I am going to explain to you how we do that. So the the thing that we do is we have to decide on the dollar risk per trade. So what we have to simply decide is how much I want to risk on a single trade in dollars. And that depends on the size of your account. It also depends on many other things. So I will give you an example of a $10,000 account. So if you have a $10,000 account, a good measure of how much you want to risk on a single trade is around $200. So why am I saying $200? Because that's close to 2%. It is actually 2%. So anything close to 2% is a good estimate for a beginner to, excuse me. So yes, anything close to 2% of your account is a good value to risk on a single trade, but this is just an estimation. It also depends on you, what you are comfortable with. So if somebody might feel that they are new and they're inexperienced, $200 is, they don't want to, they want to risk less, or somebody might feel it's too less. They can actually risk not 200, 300 or 400, right? But my advice is if you are new, if you're a beginner, it is always better to stick to a value around 2% of your account for risking on a single trade. The reason for that is that you're going to make a lot of mistakes and they are very common, and you are going to overtrade if you're a beginner. So you would be actually going into too many markets, and that is natural and normal. And until you gain more experience, you start to pick better setups, you understand the importance of selectivity. So it actually is gonna be very easy for you to lose 8 to 10 trades in a row. And if you lose 8 to 10 trades in a row and you're risking 2% on a single trade, and let's suppose you lose 10 in a row, you have lost 20%. So 20% still is not that bad. You still have 80% of your capital with which you can actually recover. So what I'm saying is you need a lot of margin, especially if you are not experienced or if you're just starting your trading journey. So you need to stick to a value which is maybe close to this figure. Other than that, yes, there are people who probably it also depends upon your financial goals. It depends on obviously how much money you have, how much money you have to lose. So this depends on many things, but this is just a guidance that I am giving you. So once you select this amount that you want to risk per trade, then you should not be changing this amount over trades. So this amount then remains constant across trades. The second thing is you need to put a stop loss. So this is extremely important. If you don't put a stop loss, then there is no concept of doing risk management, because if you don't put a stop loss, you are not gonna know, how you cannot actually limit your risk if you don't have a stop loss. What is going to stop the market from going against you? So stop loss, as you know, is an automatic built-in order in the platform that you place in case the market does not move in your favor. So if it doesn't move in, if you're a buyer and the market is moves down, or if you're a seller and the market moves up, in both cases, there's going to be a stop loss at a certain value, at a certain level, which is going to just close your trade and book a limited loss. Now, this loss is actually going to be equal to the dollar amount that you decided. And I will just explain how. So now we come to stop losses. So how do we put a stop loss? So if you go here, and if let's suppose you want to place a buy trade, you click here, and you have to press this button, protection, and this is the stop loss price level that you can put in. So in this case, let's suppose we want to enter at market. We can put a stop loss below the tail of this rejector here, which is a bullish price action signal. And I've discussed this in my past webinars about price action signals and entries and everything. So we always put a stop loss below a market validation point, below a point where we feel that we were actually wrong in our thesis, or we were actually wrong in the direction of the market. So again, the analysis has to be done on higher time frame, like the daily or the weekly. You have to study the trend, whether it's going up or down. You have to look at the price level. Is it an important price level? You have to observe the price action on that level if it's in your favor. And once you get all this set up, once you recognize a favorable setup on the charts, then you do your risk management. And I have done a lot of webinars before on how do we read the markets, how do we look at the trends, how do we look at support resistances, decide where to enter and how to enter. And you can find a lot of them on Amana's YouTube channel, and we're still in the process of uploading the last few, which I did in May. So if you want to know about the strategies that I teach, you can look at those recorded webinars. Yes, so let's go back to the risk management. So here I see a rejector, which is a tailed candle. So the downward tail is representing upward pressure in the coming days. And how will I place the stop loss? I am going to place the stop loss below this tail of this, right? So I'm going to put the stop loss somewhere here. Sorry, somewhere here. So my stop loss level can be approximately 4358, right? So, so this is my stop loss level. I will put this number here, 4358. This is the price level. And then, I have to actually go on, and when I've calculated the units, I will have to change this from amount to unit. So I always change this to units because in the risk management, we are calculating in units. So how do we do the calculation? The calculation for position size. So position size, which means the quantity. In this case, it's going to be ounces because gold is measured in ounces. So how many ounces are we supposed to trade? This is what we're trying to calculate. So on a $10,000 account, as I said, approximately if we are to risk $200 per trade, then the risk on the trade will be $200. So this is the formula for the quantity. So we take the risk and we divide it by the stop loss size. So in this case, assuming a $200 account, we have the risk is 200. We divided that by stop loss size. What is the stop loss size? It's the distance from the stop loss to your entry. So the distance from the stop loss to entry is 4491 minus 4358. This is 133, which is actually a wide stop loss, but it is the right stop loss placement. So how did I get 133 again? The stop loss size is the market price minus the stop loss price. So 200 divided by 133 gives me I'm only allowed to trade 1.5 ounces. But again, this is an example. I'm not giving any recommendation. I'm just making you understand how do we calculate the position size. So in this case, if I have to limit my losses on this trade to $200 and I need to have the stop loss of my choice, which in this case is below this point, which is the right stop loss placement, then I can only trade 1.5 ounces with these parameters. So the two parameters will decide how much I can trade, right? So I can actually round off 1.5 to 2, which will mean I would be risking a little bit more than 200, but it's okay. But this is just, you can round off the figure. It is just an estimation. You can round it to 1 or you can round it to 2. Okay. So with 2, you are actually risking 133 times 2. So you are basically risking $266 on the trade, right? Which is close to. So assuming if you were risking not 200, but you were $500, then we do 500 divided by 133, which is going to be 3.75. So I will round off 3.7 to 4, right? So I can write 4 here. So that will that means a little bit more than 500 is being put to risk, but it is close to 500. So this is the most essential thing that you have to do after you have identified a setup. And if you don't do this, then obviously you are just exposed to the market and you're exposed to all the emotions that will come with not doing the risk management. So actually, risk management does help you a lot with your discipline as well as with your trading emotions. Because once you have a set risk, you become calm and you know, okay, the worst is, okay, I can lose this amount and nothing else can happen to me. But if you don't have any risk management in place, you don't have any stop losses, anything, then you are always going to be in front of your phone or whatever, and you will always be nervous. You will always probably be watching every small move, big or up, because things are unpredictable. Doing this kind of a thing, putting a stop loss and going in with a certain quantity, makes things very predictable, at least at the capital management side, if not at the side of the market. So at least if one thing is controlled, if one thing is predictable, that can actually lead to you becoming more calmer, becoming taking better trading decisions, not doing a lot of things that you should not do. Yeah, so this is something which is essential. So I have gone through this, which is we define the risk per trade first, and this is the risk on a single trade. So if I'm taking two trades, then in this example, if the risk per trade is 1,000, if I'm taking two trades, it will be 1,000 each. If I'm taking three, it will be three. So it will be 3,000 overall, 1,000 going to each. Okay. Second thing is we have to define the stop loss, and that has to come from the chart, and that has to come according to the market structure. You can't just put a random stop loss. You can't just say I want to put a stop loss of 50 points or 20 points or 30 points. That doesn't make sense because you might be actually stopped out very easily, even if your premise was right, even if your outlook about the market was right. If you put a wrong stop loss, you can be just stopped out, and the market can then just reverse and move right as you predicted. So this happens with a lot of people, and they ask me that, I don't want to put a stop loss because I'm afraid the stop loss will hit. And it has happened to me many times. The stop loss got hit and then the market reversed and it went in my favor. So I don't want to put a stop loss. That is actually not correct, because the problem is you are not putting the stop loss at the correct level. Your stop loss is probably too small. It's probably too tight. And if you are an intraday trader, that's going to happen. So I personally am not an intraday trader. I trade on the daily and the weekly time frames, where you actually get the real picture of the market. So if you go here, you can see on top there is D written. So this is the daily time frame here, with one candle representing one day, and this entire chart is representing at least the prices from November to June. So I have a lot of price data in front of me, which can actually help me understand the market more, and and the trends and the structures and the swing points, which will also help me place the stop loss in the right way, right? So I will give you another example. Let's do another example. Let's go to S&P, which is the favorite market these days. So it's high upon high, right? Because of the AI. In S&P 500, which is the index of the top 500 blue chip companies, what we can do is, if you look at the trend, it's very bullish. Nobody can argue about that. And this bullish trend has been in place since at least 2-3 months. So here, I'm just going to give you another example of risk management. So first of all, the first step is identification of a trade. Again, this webinar is not covering how we identify trades. I have done that in many webinars previously. So as an example, this was a good entry point. So prices are bullish, market pulls down, it gives you a price action signal, in this case an engulfer, to enter. So how would you do your risk management, right? So I'm going to assume that when we were here at this point in time, so this was the market price. Let me just draw two horizontal lines. So this, on this setup, if you're trading, let's assume this was the market price, and then the stop loss is going to be placed below this setup. So the stop loss gets placed here, here, below these two candles, right? So this was my entry, this was my stop loss based on this signal. How do I calculate my risk, my position size? So your position size is equal to your risk on the trade, right, divided by the stop loss size, right? So in this case, if I'm, let's say, taking a risk of $500, it's going to be my 500 divided by the stop loss size, right? What's the stop loss size? It is the distance from the entry to the stop loss price. So if the entry is 7433 minus 7343, that's 90 points, right? So I write 90 here, and what do I get? I get 5.55 contracts of S&P. Or so you can look at S&P like a big company, and one share is equal to whatever, this price. It's not actually a company and it's not actually a share price, but it's an index. And this is a representative number. But if we have to understand what S&P simply is. It's a basket of the top 500 US companies. It's a representation, a benchmark of the entire US stock market, and it's the best representation. So to understand this number, just to make things simple, you can think of it as a big company which has 500 small companies inside it, and the share price of one company is $7,621. It's not actually like that, but just to simplify it, I'm giving you a simplification. Okay. So 5.55 means like we can trade 5.5 shares of this, or we can round it off to 6 or 5. So what I'm going to do is I'm going to go buy here. I'm going to change this to units. I can write 5 or 6, depends. So let me write 6 contracts. In protection, I will put my stop loss price. So we decided the stop loss was here, 7343, and then we're just going to press buy and confirm. So a very calculated risk. I know my position has a my position has a risk of 500 and I'm okay with it. And if the market moves against me, I'm going to lose this amount. But because I have studied, I have a lot of reasons why I took this trade, the market will most probably not move against me. Most probably it will go in my favor. But then again, there's always a possibility, no matter how good the setup is, that it might not. So this is the reason for the risk management, and this is the reason. Okay. And yes, once market moves in my favor higher up, which it did. So suppose we had entered here and now the market has gone up, you can actually bring your stop loss, you can trail it to the break even point, which means you can push your stop loss up to your entry level once the market moves in your favor. And what that does is that removes all the risk on the trade. So now you have a riskless trade running. It does not have any risk, right? So changing, you can always change your stop loss. So you can go to positions. You can see this position here. You can click here. You can do modify. And in modify, you can change this stop loss. All right. So in this case, we will obviously change it to a higher level, not to a lower level. If you lower it, your risk will increase, right? Because you calculated your position size based on this stop loss. So don't drag it down. There's no point if you just drag this more down because you're afraid it will be hit, then you're not really doing risk management properly. So I hope that I am clear about this, about these examples. Okay. I have a question. How do you bet against the market? I need to actually be more clear about what you mean by betting against the market. So, do you mean to say that how do you take a trade against the market? As in, if a market is bullish and you want to take or you want to short the market? I mean, if that is what you mean, this is what I've understood. How do you bet against the market? So, the thing is that yes, if you speculate an index to go down, okay. The thing is, I think you're talking about possibly picking a top, right? So I actually think it's not really a good idea if you have a very well-defined trend in one direction that you bet against it, because I don't understand any sense of that, since if a market is giving you more gains, if it's trending upwards, let's say, why would you want to bet against it? Because you know that even if it does dip, if it does retrace, that movement will be small. That movement is not going to be as big as the major trend of the market, right? So, in this case, for example, why is there actually a reason for me to short this market or to assume? I cannot assume that this market will go down because I don't have any reason to assume that at all. I can see that a very strong trend is in place since the last few months. The market has not given any indication that this trend will change. So I cannot just simply assume that because the market is so high and this is some sort of a bubble and it will burst and everything will come down. It's not based on anything that I can see right now. So it's not a good idea to bet against it, unless, of course, there could be some very, very clear price action signal, let's say, after a rally. So somebody might make some money from there because there will be there will be some retracement. But then again, that's not a major move. It's not going to give you a very good risk reward ratio for that trade. So why do we even want to, do that? For example, in this market, this was a movement against the trend, but a very small one. Here, I just had the consolidation. And if I look at this overall on the higher time frames, so what do I see? I just see very aggressive bullish trend over a long period of time. So, and generally, S&P's average time of being in a bullish run over since it was created is 5 years, and the bearishness is from 9 to 10 months. So I think we should rather stay with the trend so we can benefit more than, trying just assuming it will come down. See, for the index to actually convince me that this is a downtrend or whatever, it has to be a very drastic loss of value because there was, I think there was a 20 to 25% correction during COVID, and that was all recovered in 4 to 5 months. So even if I see a correction of about 20% in this index, I am not going to be bearish on this. I will treat this as just like a regular bigger dip and just get ready for another chance to buy. Actually, this is how I think. I know there will be people who will think differently from me. I have friends who have been trying to short the indices for like years and years. So they have their own way of thinking. And maybe they are expecting that it's too high and it's going to go down. And so, what my personal strategy is, I will be in line with the major trend. So my positions will be in line with that. Unless it's a range bound market like oil. So we have in Brent, we have something like this. So this is a pretty range bound market. So here on these levels, I could look for buying signals and on the upper level for sell signals. So this is a different market. It has a different structure. It's not trending. But it's very nicely range bound as well. Okay. Okay, so you are saying so you can benefit from a market downturn like a crash in 2008. See, the thing is that you I believe you need to see reasons. You need to have reasons for a crash, right? And if it's going to be such a big crash like the 2008, definitely, first of all, there will be a fundamental story behind it. It will be in the world, right? Like a war or, God forbid, something big. So first of all, it has to be supported by a fundamental story. Secondly, yes, we can benefit from it by shorting, but then what I will need to see some amount of bearishness persisting over a period of time, right? Let me try and look at I don't think I have data going back no, I don't have it going back to 2008 here. See, the indices do go down, they do crash and all, but like I was saying, 80% of the time they're going up. So rather than focusing on the crashes, we can actually focus on the upside, which was there more times than the downside. Can you repeat how you decide the stop loss size? The stop loss size. So what I do is first you have to decide the stop loss price level, right? So in this case, let me give an example. I will just go back to the previous example. What you have to do is stop losses are usually placed below or above swing points on the higher time frames. That's the safest stop loss placement. You can place them in other places if you're a lower or an intraday trader, then your stop loss placement is going to be quite different. But the safest stop loss placements, in my opinions, are under swing points on the higher time frame. So what are swing points? Swing points are points which are swinging the market like this, right? So this is swinging the market, right? So you have these V shapes or U shapes here, right? So in this case, this is a swing point, this is a swing point, this is a swing, and we are on the higher time frame, we are on the daily. So the daily and the weekly are the higher time frames. So what you do is, if you think a market is trending nicely, so in this case, this is an uptrend, the stop loss placements will go here. Once this formation has ended, so once this thing has formed, the stop loss goes behind it. And it's the same for a market which is downtrending. So I don't have a very good example right now of any market which is in a downtrend, which is in a perfect downtrend. But if it is downtrending, then we will be shorting the market and we will be putting the stop loss above the swing point. In this case, when we are a buyer, it will be below. So it will be here or along these points, right? So once you have decided the stop loss, again, in this case, if you place the stop loss here, the stop loss level, then the stop loss size is given by your entry price minus the stop loss price. So your stop loss size is your entry, the price at which you entered the market, minus stop loss price, right? And this stop loss size is again used in the position sizing. Position size is what? It's the quantity you trade that will be equal to your risk on the trade divided by your stop loss size, which is your entry price minus stop loss price. So I hope that answers your question. So I have one question which says, how can you buy a stock and hold? So if you want to just hold a stock and not trade it, then it's better to hold it in an unleveraged way. So there are two types of stocks, like, if I do Apple, okay, I cannot find this leverage. There has to be unleveraged as well. So this sign here, the purple sign in front, means that it is leveraged. But if you want to just buy and hold and not do any trades, then it's better to hold the unleveraged one, because the unleveraged one is not going to have an associated overnight charge with it. So I cannot actually find this, but I think we can remove if you request, they can remove the leverage from this. And then if we have anything like, okay, this is leveraged. Tesla. Okay, let's say if you want Tesla, let me just check this. Tesla, what is the leverage here? We have to go down to, it's 2 to 1. Basically, what it means is, if, like, you want to buy 10,000 worth of Tesla, then you only pay 5,000. Okay? If you think that's a good idea, that's fine. You can use a little bit of leverage, but then there is a small overnight financing fee that you have to pay because you are using the leverage. And if you don't want to pay that overnight fee, so that fee is charged after every 24 hours. If you don't want to pay that, you can request for the leverage to be removed, so it will be 1 to 1, and then you can just buy the stock and you can hold it. So non-leveraged, anything which is non-leveraged, you cannot short it. Please remember, you cannot benefit from the price fall if it's not leveraged. I hope that I have answered all your questions, and I hope that you liked today's session and you learned from it. So again, I will see you next Tuesday, and the topic for next week is risk reward ratios and exit strategies. So there we will discuss that once you have entered the market, where should you actually come out of it? How much profit is enough, and what factors make us decide that this is enough and we need to now close the trade. And that is actually one of the most important and trickiest parts of trading, because many people can recognize a good setup, can do the risk management, but once they're in the trade and they're making profits, they just don't know where to come out, how to book the profits, or what else to do. So this is something we will discuss in the next webinar. And thank you so much, and I will see you next week.